Live from Asia, Europe, and the United States, this is CNBC's Worldwide Exchange.
Very weak crosses. It's hard to believe, but that's where we have been this morning as far as the currency markets are concerned. Brian.
Well, Ross, let's get more details on what happened, of course, overnight with the Fed and J.P. Morgan buying Bear Stearns for $2 a share. Let's start with Emily Sanders, CEO of Sanders Financial Management, and Sean Darby, head of regional strategy at Nomura International. Let's start with you, Emily. I mean, obviously, there's so many elements to this. We have obviously the spillover impact on the dollar. We have this Fed involvement here to backstop this deal with J.P. Morgan. For you, talk about what the implications are for you.
Well, Ross, good morning. Bear Stearns at $2 a share, that's a clear signal that it really should have gone bankrupt. And J.P. Morgan got a pretty good bargain basement price, much better than Bank of America got for Countrywide Financial a few months ago. So as far as what goes beyond the $2 price, what happens to the signature building, what happens to the people, they have good people, but clearly their management was weak starting back in August 2007 with the subprime crisis. And it's really unfortunate that the fifth largest investment bank in the U.S. went this way. But really, these are market forces, and we're in a cycle of greed and fear. And right now, fear is at its height.
Well, Sean, let me put it to you, because it was so clear in the language from everything that came through the news flow that this deal had to get done, they thought, before markets opened in Asia. Of course, then we see a broad sell-off in Asia. Is the interpretation that we would have had a huge, huge sell-off in Asia had they not got this deal done?
Well, the general feeling here is that this is just the sort of first part of the whole unwind of the debt excesses in the United States financial system. And my suspicion is that probably we're going to face the same problems over the next course of the next few months as we get more companies marking to market the debt, and indeed that the credit spreads are indicating that we probably are not over the worst yet. So I think the Asian financial markets have been pretty much aware that unfortunately we would have some casualties from both the fallout from the subprime and also the fact that a lot of these debt instruments would need to be marked to market over the course of the last few weeks.
Sean, what's the biggest danger here for investors in Asia? Is it the dollar decline, or just simply, as we heard from the head of Hong Kong Shanghai Bank over the weekend, look, there is no decoupling. If the U.S. consumer goes into recession, we will be hurt?
Well, I think there isn't really any impact directly on companies from the problems in the United States financial system, apart from one or two of the banks here which have had some CDO exposure. I think for the markets, the problem is that there is an element of contagion now, that we've seen that both the credit market turmoil now spilling over into quite vicious moves in currencies. And this is really where it impacts Asia, because certainly we're still very much dependent upon our exports to the developed economies to keep our growth going. And secondly, I think there is also, of course, a concern that we're going to see a very sharp restriction in the household balance sheets in the developed economies, and naturally that means that our growth rates will fall even further. So the currency spillover is probably more of a worry than, in one sense, than the actual collapse of Bear Stearns.
Yeah, and Emily, what do you make here? I mean, we seem to have moved beyond the liquidity crisis into now questioning solvency. I mean, you mentioned fear earlier. It seems that what we have fear in the European banking market is that there may be another bear out there. And when you're faced with a solvency crisis, what should the reaction of investors be? I mean, when you've got fear in the markets, how do you deal with it?
Well, you're right that there is a solvency crisis, and the Fed decided to, come to the rescue, in a sense, all their various taffies and type of things like that, which actually have been good. But as far as the bear buyout, that they felt they had to do it. But I think the biggest risk now is what the Fed is going to do tomorrow, and a 100 basis point cut is called for, where really 50 should be enough, because the dollar is just in a free fall practically. It's so weak that it's creating an inflationary spiral that's spreading through oil and commodities and China and so on. So really, at a certain point, the Fed has to take leadership and just stop the rate cuts, even though they have not been effective thus far, and some of the other creative techniques have been much more effective.
Sean, do you agree with what Emily just said? Christine here, do you believe that the Fed should follow through with a 100 basis point rate cut tomorrow?
I believe that we should only really be seeing, again, only a sort of 50 basis point cut here. I think the rate cuts have been shown to be just pushing on a string. I think the unorthodox measures are the last resort, or the lender of last resort for the Fed. And indeed, if they keep cutting rates so aggressively, I think there is a very destabilizing force for currency and for financial markets. And really, I think the Fed will be dealing maybe with one problem in the banking sector, and maybe even a currency problem. So I would be in the camp that the equity markets and the financial markets may be disappointed by the Fed's actions. I think they will now undertake more unorthodox action rather than using the Fed, the interest rate tools. I think there is quite a possibility that the Fed's going into an unknown scenarios, with some of these very, very aggressive scenarios being highlighted by perhaps some of the investment banks.
Well, you can see why there's a lot of fear out there. This Bear Stearns was valued at about $3.5 billion in terms of market value, and now it's going for less than $250 million. So who knows if there will be another shoe to drop. Thank you very much, Sean Darby, Head of Regional Strategy from Nomura International, and Emily Sanders, CEO of Sanders Financial Management.